Welcome to the chapter summary for Chapter 25, Financial Management. All right, so on this slide, it is just an organization chart for, I want to say, a healthcare institution. I'm not going to say a hospital because it doesn't say, but it's just a health institution. So I was going to try and make it a little bit bigger for you, but clearly that didn't work. So let me. Hi, and welcome to the chapter summary for Chapter 25, Financial Management. The first slide looks like it's just an org chart for a healthcare institution, but I'm sure that throughout the chapter, we'll talk a little bit more about each of these aspects as it relates to HIM and financial management. So this is some basic accounting concepts and principles that you should know when studying for this particular chapter or when reviewing for this particular chapter. So entity is the definition, or the definition of entity, is the financial data of different entities are kept separate. This is an accounting concept. Going concern. Going concern organizations are assumed to continue indefinitely unless otherwise stated. Stable monetary unit. Money is the measurement of financial transactions. Time period. Financial data represent a specific time period. Conservatism is resources must not be overstated and liabilities must not be understated. Materiality is the financial data collected by organization are relevant to its goals and to its objective. Reliability. Amounts represent the transactions that occurred. Cost. Transactions are recorded at historical cost. Revenue. In order to record revenue, it must be earned and measurable. Matching. Expenses are recorded in the same period as the related revenue. Consistency. When an accounting rule is followed, all subsequent periods must be reflect the same rule. Disclosure. Financial reports must be accompanied by helpful explanations when necessary. Authorities. The authorities that could or may oversee accounting or areas of accounting, you have our Financial Accounting Standards Board, which is the FASB, Securities and Exchange Commissions, SEC, the Internal Revenue Service, IRS, Public Company Accounting Oversight Board, PCAOB, and then the Centers for Medicare and Medicaid Services, CMS. The forms of business organization. There are several forms of business organizations. So they could be a sole proprietor, a partnership, a corporation. There's also more, but let's stick to what's here in the chapter, right? Okay, so for-profit organizations, a financial organization, they could be a for-profit organization, they can be a not-for-profit organization. Not-for-profit organizations can be I want to say labeled or classified as a 501c3 or a 501c6. So in some states, let's say, for example, in New Jersey, charitable organizations, they must register with a regulatory body in addition to obtaining a not-for-profit status. Okay, states require this in order to protect consumers and to monitor solicitation practices. Okay, students can research requirements in their home state or of their home state, or you can go to the IRS website to review IRS Publication 557, which contains detailed information about the types of organizations that can be tax exempt. Sources of financial data. This can be transactions, clinical services, patient accounts, right? How do we earn our money? HIM, we are a revenue generating department, right? Because we are coding, and then administration, okay? Uses of financial data. How are we going to use the financial information, right, or the data for reimbursement, for controlling, and that can be controlling costs, for planning future costs, or forecasting. Okay. So some basic financial accounting. Financial accounting is all about communication. Financial data is used to communicate with external stakeholders as well as to build internal communication tools such as a budget or a productivity report. Okay, so we want to make sure that we are measuring our transactions, we are recording our transactions, and we are communicating. So when we talk about assets, things that can make up assets or can be considered assets, it's going to be your cash, your inventory, your accounts receivable, the building itself, that's an asset, and then any equipment. So when we purchase equipment or when we talk about equipment, you want to think of two things. You want to remember that purchase price, and then you want to understand how that piece of equipment depreciates. So what I love about this chapter is, though we're talking about healthcare organizations or settings, this can apply to our personal life and our personal finances as well. Or whether or not we own a business, right? This could apply to our business, or these are business concepts that we need to know in order to run our business. Okay, so, and I'm thinking too, when we're filing our taxes, right? These are things that would be helpful to know. So I'm going to keep going. Liabilities versus net assets and equity. So accounts payable results from routine transactions. Notes payable are sort of an extended payment plan for businesses, okay? Your mortgages are long-term and have underlying collateral, such as the building, right? We can use that building as collateral. So, okay, so the equation, assets minus liabilities equals your net assets or your equity. Revenue versus expenses. So when we think of revenue, we must think of our sources of revenue, the different categories of revenue, which could be operating revenue or non-operating revenue. When we're thinking about our expenses, we're thinking about purchases, we're thinking about um, purchase orders, any shipping and receiving documents, invoices that we send out, statements, inventory slips. So, illustrating the equation, students who have not taken a separate course in accounting may relate better to this example if they see assets as a combination of their checkbook balance and the things that they've purchased, right? Your liabilities as your credit card balance, or your car loan or your mortgage, and then your equity as the net value of those two. Recording transactions. The most common practice is a double entry bookkeeping, right? You want to make sure that you are keeping track of your debts and your credits, and then the impact that these have on your individual accounts. So double entry bookkeeping, here is a visual of what that looks like. You see your assets here, anything that you've purchased, maybe under your debts, any credits, and then how that pans out here, right? Okay. Okay. So this is what a general ledger looks like. Typically, if you, this is a journal entry, but if you think about your bank statement, right, or when you log into your banking app, typically these are how transactions are listed. So I hope that looks familiar. Financial statements, a couple different financial statements. It can be an income statement, a statement of retained earnings, or a balance sheet. An income statement typically looks like this. Okay. Ratio analysis. Okay. So before I talk about ratio analysis, well, no, I'll talk about it. So when we're thinking about the liquidity and debt service, we want to make sure we understand what current ratio is, days in accounts receivable, and then that debt ratio. So when we talk about profitability, we are looking at the return on investment as well as that total margin. So in order to determine the current ratio, okay, you want to know the formula, right? So it's total current assets over your total current liabilities. Okay. Days in accounts receivable, it's going to be your net accounts receivable over your net patient service revenue divided by 365 days, number of days in a year, correct? Okay. So when we're thinking about total debt, we want to make sure that we are, total debt, but our debt ratio, we want to make sure it encompasses our total liabilities as well as our total assets. Okay. Profitability ratios, when we are thinking about that return on investment that I mentioned before, our return on an investment, or how you determine that return on investment, it's going to be the earnings divided by the total assets. Okay. To determine that total margin, it's going to be in excess of revenue over expense divided by total revenue. Make sure you write these down. So remember, we started keeping a list of our formulas, right? The formulas that we need to know for these exams. It would be helpful if you add these formulas to that list. Okay, so basic managerial accounting, we need to be able to identify costs, manage and control, as well as communicate this information. So describing costs, when we look to describe costs, there are several costs that we need to consider, okay? Direct costs, indirect costs, any fixed costs, variable costs, or semi-fixed costs, okay? So when we think about a fixed cost, it's simple, it's fixed, right? So that's going to be the same amount each time, okay? So I think when thinking about a copy machine depreciation, costs do not vary regardless of copy volume, right? If we're thinking about a copy machine. However, okay, if we're thinking about variable costs, cost of copy paper, okay, can be tied directly to the volume of requests. So that can be considered a cost that is variable. Right? Okay, so semi-fixed costs. So coding coverage, for example, in-house coding staff salaries are fixed. Per chart, consulting fees are tied to volume and increase the cost of coding variability, okay? So this chart also shows the total copy costs, whether it be fixed depreciation plus the cost of paper. See how it shows there that it's mixed costs? Okay. All right, so semi-fixed costs, this is based on a step, right? So nursing salaries, for example, nursing staffing increases incrementally according to the ratio of nurses to patients, right? So in terms of copy costs, ROI personnel costs may vary incrementally. In other words, at certain volume levels, additional personnel must be assigned to the task in order to meet demand. I hope this makes sense. If it doesn't, you know that you'll have a place to drop your questions. So semi-fixed costs, we need to think about the allocation of overhead. And when we're considering the allocation of overhead, we need to think about the direct method, the step-down allocation, double distribution, semi, yeah, simultaneous equations, and then the impact of accounts receivable on financial statements. So allocation, right? So when we have, if you look at this chart, you see how dollars, right, are allocated to HIM, to the business office, to medicine, to lab, okay? Internal controls. We need to be sure that policies are in place to prevent, to detect, as well as to correct our costs. Budgets. This is super important. You want to make sure that you understand the different types of budgets. They are fixed, or they can be, allow me to say that, they can be fixed, flexible, activity-based, or zero-based. Operational budgets. For the budget cycle, you want to make sure that you know what that fiscal period is, when it starts and when it ends, any interim periods. And then when we think about budget components, again, our revenues and our expenses. Okay, this is an example of a budget for a particular department, right? So how much is budgeted is here. The actual amount used is here. The variance, right, which is going to be your difference, our year-to-date budget versus our year-to-date actual, and then our year-to-date variance. Identification of variances. This is all going to depend on timing, whether it's permanent, temporary. Is this a permanent variance, a temporary variance? We have to consider the impact. Is this a favorable variance or an unfavorable variance? Explanation of variances. You want to make sure that you always know that amount, because this is the difference, right? So you want to know how much of a difference. What was the cause of this difference? And were there any extenuating circumstances, right? Something happened so that caused us to go over budget or come under budget, okay? So capital budget, our capital budget is going to be our large dollar purchases. Typically, this could be anything over 100,000, but each organization tends to determine what they consider to be large dollar purchases. Okay, any acquisitions, cost benefit analysis, and then we have to make sure that we keep in mind that depreciation, right, for those capital budget expenses. So depreciation, okay. This is just a visual. I wish I can make it bigger so you can see the straight line depreciation method, the units of production, as well as the accelerated depreciation methods. But again, this is covered in your textbook. We're just doing a chapter summary so that you know what to expect. Okay. I think it's also important to point out the formulas, right? So those are here. So writing those down on your list of formulas, okay? Okay. And typically, this is an example of a copy machine. If we purchased it at a price of $5,000, the useful life is 100,000 copies. The residual value is $200. So we're looking at the depreciation over a 5-year period, okay? But again, this is outlined more in your book, so you can take a look at that. Let me know if you have any questions or if it's not as simple or cut and dry as it is or as it can be. All right, so capital projects cost justification, okay? You wanna make sure that you consider replacement, expansion, the mission, right? The profitability, the payback period, the accounting rate of return, the return on investment, the net present value, the internal rate of return, and the profitability index. Okay, so let's talk really quick about the payback period. The payback period is the time required to recoup the cost of an investment. So mortgage refinancing analysis frequently use the concept of a payback period. Mortgage refinancing is considered when interest rates have dropped, right? So refinancing may require upfront interest payments, which is called points, as well as a variety of administrative costs. So in this example, the payback period is the time it takes for the savings in interest to equal the cost of refinancing, okay? So the advantage of using a payback period to analyze investments is that it's relatively easy to calculate and understand. For example, a payback period can be used to describe the time it takes for the savings and payroll costs to equal the cost of productivity, or as well as the cost of productivity in terms of enhancing the equipment. So in the previous photocopy machine example, the payroll cost would be calculated based on downtime occurred when using a copier in another area of the building. So the disadvantage of the payback period is that it ignores the time value of money, because the funds used for one capital investment could have been invested elsewhere. There's always an inherent opportunity cost of choosing one investment over another. Hence, there is an assumed rate of return against which investments are compared, and a benchmark rate of return under which a facility will not consider an investment. Okay, so another example or another simple method of capital project um, analysis is the accounting rate of return. So this method compares the projected annual cash inflows minus any applicable annual depreciation divided by the initial investment. Okay, so consider the purchase of, let's say, a CT scanner. Reimbursement from the use of the machine is the cash inflow, right, that we get from doing these CTs. Depreciation is easily calculated based on the initial investment. Accounting rate of return is another example of a simple method of capital project analysis. However, it also ignores the time value of money. So in addition, accounting rate of return is based on an estimate. So if the analyst incorrectly projects annual cash inflows, then the projected rate of return will not be correct. Okay, so the return on investment. ROI, right? And I love this chapter because I'm thinking every time I see ROI, I'm thinking release of information, not return on investment. But be sure that when you are testing, right, and going through these questions, you understand what it's referring to. Okay, so return on investment is the most frequently used or is most frequently used to analyze marketable securities respectively or retrospectively, excuse me. So the increase in market value of the securities divided by the initial investment is the ROI. So when an income stream is associated with the investment, the income stream is added to the market value of the securities in calculating return. So in comparing the ROI among different securities, the tax implications must be considered. So long-term gains are taxed differently than short-term gains. So tax-exempt investments result in different tax returns than taxable investments. So with respect to capital investments, the equation is similar. Divide the controllable operating profits by the controllable net investment. Operating profits are the cash inflow minus the direct cost of operation. So as with accounting rate of return and payback period, ROI is easy to calculate and understand. Similarly, it does not consider the time value of money. Okay. So to take into consideration the time value of money, the analyst must establish an interest rate at which money could have otherwise been invested. So from that implied interest rate and the projected future cash inflows of the investment, the present value of the cash inflows is calculated. Present value is the current dollar amount that must be invested today in order to yield the projected future cash inflows at the implied interest rate. So net present value is the calculated present value of the future cash inflows compared to the initial investment. The advantage of using net present values to analyze investments is that it considers the time value of money. So when choosing among like investments, net present values can be reliably compared to determine the financial advantages of the investment. So as with other analysis tools, analysts may have to estimate the projected cash flows. However, the main disadvantage of net present values is that the interest rate is subjective. Therefore, it is best to use to compare multiple investment opportunities rather than to analyze one investment alone or by itself, right? So another disadvantage of using net present value is that it requires some knowledge of math to calculate as well as to accept its validity and to understand its relevance. So fortunately, financial calculators and computer spreadsheet programs have made the calculation of net present value relatively simple. So the internal rate of return. The internal rate of return is the interest rate that makes the net present value calculation equal zero. So in other words, it's the interest rate at which the present value of the projected cash inflows equals the initial investment. So IRR, internal rate of return, considers the time value of money. Both individual and multiple investments can be evaluated. As with net present value, a knowledge of math is helpful. Okay. The main disadvantage is that the project may have multiple IRRs. All right, so the last concept considered in this chapter is the profitability index. So facilities cannot automatically invest in seemingly profitable projects. So for example, a $500,000 radiology equipment investment um, may have a present value of cash inflows of, let's say, $1.5 million for a net present value of $1 million. At the same time, a $10,000 pharmacy computer system yields a net present value of $30,000. So this seems to be a great investment. However, the facility's capital budget may be limited to $100,000. So in this case, a profitability index helps the organization prioritize investment opportunities. So for each investment, you want to divide the present value of the cash inflows by the present values of the cash outflows. So in this example, the pharmacy system has a higher profitability index. So I hope that you found this chapter summary to be helpful. Okay, if you have any questions, please sure to drop them below in the Domain 5 Q&A forum. If you want to set up a separate tutoring session for math, please know we can do that too. All right, well, thank you so much.